Hello, today we will be studying on revenue, IFRS 15 with couple of scenarios. There would be 4 questions. Each is different type of scenario. Let's start. Number 1, Mocha is a company. On March 1st, Mocha sold some plants for $500,000 and the sale contract included a call option. It means Mocha has a right to repurchase the plants in 1-year terms before 30 April next year with the price of $550,000. In the initial recognition, March 1st, control, this is the critic. Okay, this control has not been transferred yet. Control has not been transferred to another party. Still, Mocha has control over assets until 30 April. This is cash because Mocha has collected the money of $500,000. And credit, if it is not the revenue because of not transferring the ownership of the plant, this is a kind of liability. Liabilities. But after 1 year, only Mocha, if pay $550,000, it has a right to repurchase. It means liabilities cannot be 500,000. Liability should be 550. And difference between each would be finance cost. P&L. If the option is exercised, it means if Mocha decided to repurchase the plant on 30 April, it's liability. Credit, cash, trade, payables, whatever it is, because cash out should be 550. What if the exercise is not, what if the call option is not exercised? Unexercised. Unexercised. It means this is a revenue because the control will be transferred to third party, which is now customer. It again liabilities. And credit should be revenue. Okay, I hope it's very clear. And now, question 2, sale of goods and service. Mocha sold a machine to a customer. Mocha invoiced the customer for $500,000 on April 1st, and the customer paid the same amount to Mocha on 15 May. The term of sale stated that Mocha would service and maintain the machine for 4 years. From April 1st. It means there are 2 types of sales. The first one is transfer machinery to third party. Second is the service and maintain this machine for 4 years period. And Mocha normally charges the annual fee of $37,500 for service and maintenance, and machine normal price without service and maintenance, which means standalone price is 450. We need to calculate the portion of each type of sale of machine. In the given scenario, it is 450, and service cost, service and maintenance was annual fee of 37,500 multiplied by 4 years, and total price is 600. But Moco invoiced the customer for these two type of sales together $500,000. Uh, 75% and 25%. And total invoice in the scenario, total invoice amount was 500,000. And let's calculate service and sale of machinery with the portion already calculated over above the here. We pay $375,000 for machine and $125,000 for service. So, in the initial recognition on April 1st, machinery has been already transferred to third party to client. Let's say trade receivable. Because let's do it 15 May. Then cash 500 here already collected, and revenue of machinery should be recorded here, and service is not provided, has been not provided yet, so you need to record it as a liability. Once the service is provided, portion of provided part should be recorded as revenue. In 4 years terms, the liability will turn to revenue for service and maintenance part. And now the third one. On 20 September 2015, let's say, Collier sold 100 identical items to customer for $2,000 each. The item cost Collier $1,500 each to manufacture. It's a cost of production. Term of sale are that the customer has the right to return the goods for a full refund within 3 months. Customer has a right to return the products, and after 3 months period has expired, the customer can no longer return the goods and payment becomes immediately due. Collier has entered into transaction of this type of with customer previously and can reliably estimate that 400% of the product are likely to be returned with the 3 months period. On September 20, 2015, debit trade receivable it was each of 2,000 multiplied by each of 100 multiplied by 2,000 as price. Trade receivable would be 200,000. Revenue should be 96% of the total amount because 4% is estimated that the customer may give this product to Collier, and credit also liability. And also for cost of goods sold part, cost of goods sold, the cost of each was 1,600. Multiplied by 200. But in the initial recognition, still there is a possibility that 4% of the product might be returned to manufacturer named Collier. And in the initial recognition during the sales, the whole amount cannot be recorded as cost of goods sold. Again, with same as revenue, we need to calculate 96% of total cost. And what about remaining portion? Manufacturing cost is a right of return. We need to treat as an asset and credit, of course, inventory. If in 3 months period, no return, after 3 months, with no return, credit liability, revenue, also, also debit cost of goods sold, 6.4, credit rate of return. Okay, let's go to number 4. It's an interesting one. Calibre Co builds an apartment which normally take 2 years to complete from the date of signing the contract. This is important. The title and possession and therefore control of the apartment blocks pass to customer upon completion of the construction. It means after 2 years, the customer would have a right to control this apartment block. The price which is payable on completion of each apartment block is 955 million. After 2 years price, be careful. After control, once control take over another party, after 2 years, the amount would be paid again this term after 2 years of the construction starting, which is 955 million. Alternatively, customer can pay 6.5 million cash on the day of the contract is signed. You have a right to pay 8.5 million as cash at the beginning of the construction, and you will wait the 2 years of completion period, then you will have a right to control the assets. Or alternatively, you need to wait for 2 years, then you are going to pay 9.55 million. And 8.5 million, and after 2 years, 9.55 million. The related appropriate borrowing rate was 6% for Calibre. And I think here is one of the customer already paid at the beginning of the construction, which is 8.5 million, and Calibre recorded this amount as revenue. Is it true or wrong? Let's check. Price here. Price 6.55. Term 2 years. Cash price 8.5. Interest rate 6%. Okay. Revenue cannot be recorded unless control passed over another party. Here, we need to wait for 2 years at least to recognize the payment or any commitment as revenue because of the still having a control. Okay, and it means in the initial recognition made by the Calibre as revenue of 8.5 million was wrong. Just it might be a liability. Initial. Here one and year 2 ends. In the initial 5, year 2 liability should be initial recognition multiplied by relating borrowing rate. Okay, or and year end. Here we will already reach 6.55 million by using 6% borrowing rate. Okay, initial recognition. Debit, cash collected. As you know, credit should be liability. Why? Okay. Year one ends. Debit, credit, credit liabilities. Difference between initial and year one ends. This is liability now. We add 8.5. We add on 8.5. Okay, and the balance would be year one ends 9.01 here, and credit should be inventory, not finance cost, because it's about construction, and this finance cost through inventory will go to cost of goods sold at the end of the period, which was 2 years. And what about year 2? The same record. Yes, and once the control is transferred to the customer, liability will go to revenue. Okay, credit, revenue. It was the price already given by the supplier, constructor, which was 9.55. And finance costs on inventory and other construction costs might be staff, depreciation, raw materials, etc., will go to cost of goods sold at the end of the period. Completion level is not important in this scenario because in the given scenario, control has passed over the customer at the end of the construction period, which was 2 years, and customer doesn't have a right on the asset such in year, for example, year 1. Because of this reason, we cannot use completion level in this scenario. Okay, thank you for joining me and watching my video. See you hope in another video.